This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk, and the majority of retail clients lose money. Do not invest any capital unless you understand the risk and you're prepared to lose it all.
Welcome to my channel. As promised, I'm going to go through cycle theory for technical analysis. I just finished chapter 1 of Walter Bresserts' book. It's The Power of Cycles and Oscillators used in combination. Gives you like a 70% probability. I'm gonna highlight the points that I think were important in the book because some of it is a little bit outdated. So I hope you enjoy. Please like and subscribe down there. Hit the bell for notifications. All right, so let's start with chapter 1. So cycles are found everywhere in nature. Some examples are the Earth rotates around its axis to create day and night cycles. Furthermore, it tilts at an angle from its axis to create a seasonal cycle. We have these cycles you might not even realize, such as our sleep cycle. We awaken and then we go back to sleep. Cycle analysis of the markets assume that the current fundamental information available is relative only to the current price structure, and that fundamental events will occur to move prices in the direction of the cycle. So there's a couple of types of cycles that Walter Bresserts labels in order of dominance. Like, so a cycle, a larger cycle has smaller cycles with a smaller cycle and so on. So it's almost like an Elliott wave thing, like the major waves and then the smaller waves, same concept. So the first one is the long-term dominant cycle, are longer than 1 year in length. And most of these long-term cycles range from 2 to 11 years. These are your major lows. This is like when you go hard, you know, you bet a lot on these. These are the ones every couple of years chances you're going to get to go long, right? Because you're buying the bottom of the cycle. There's also seasonal cycles, but they're more for like agricultural, like food and like stuff like that. It doesn't really, I mean, there are seasonalities in the S&P and the stock market and such forth. We'll go over that later. The next one is your primary or weekly cycle count. This is one of the dominant ones over the shorter 1 year. This is the dominant weekly cycle compared to the daily, but it's shorter than 1 year. So like it's the Bitcoin, I believe, off the top of my head, is like 24 to like, I think 40 something, 44, 42 weeks. The cycle usually comes in around there, the cycle bottom. And every time you have a weekly cycle bottom, it has to coincide with a daily cycle. So right here, you could see the weekly cycle, the primary weekly cycle is a dominant weekly cycle shorter than 1 year. The average cycle length ranges from 9 to 22 weeks. And every asset is going to be a little bit different, you know. There are also half cycle counts, which we'll get into. Like you could have a half cycle low, a half cycle high. This trading is actually daily. That's a misprint. It's the trading daily cycle measured in days. This is used to enter and exit the markets for short-term trades. Within the trading cycle, there are 2 sub-cycles, each normally half the length of the longer daily cycle. The trading cycles do not have its own crest or high. It will always have a crest or high at the same time as one of the shorter sub-cycles, the alpha and the beta. I'll explain that more and I'll show you a graphic so it makes more sense. Okay, so here we have the alpha cycle. It's the first smaller cycle coming out of the daily cycle low. And the trading cycle, daily cycle, will always begin with a new alpha cycle, all right? So it's the first cycle out of the daily cycle low, which is the trading cycle. And it's also, it begins the alpha cycle. It begins the cycle, the daily cycle. And then you have the beta cycle, which is like the second half of the this daily cycle. And this starts to come in as it's bottoming to the next daily cycle low. So that doesn't make much sense until you see this graphic that I got. This is from Walter Bresserts himself. Let me make sure I get it. Here it is. Okay. So here it doesn't show the yearly cycles here because those are your dominant trend, you know, and the trend is your friend. Then you have seasonality, but we don't really do that much. And then you have your primary cycle, which is also your weekly cycle. And then you have your half cycles, right? And then you have your your trading cycles or daily cycles, and then out of your daily cycles you have your alpha cycles and your beta, and based on which way the lows come in, like the low and the low and the low, that would be an uptrend. So on this one you can see a lower low and a higher low, a lower high, I'm sorry, lower high and a lower low would be your downtrend. So that's how you kind of know where you are on because you have to trade the trend with the cycle trading, or else it doesn't work. But it is very effective if you use it properly. So that takes care of that. So this is another one that shows you the simple cycle, and this is how the trend, and this is how they translate. Let me get that. Okay, so an important characteristic of the daily cycle is its relationship with the next longer dominant cycle, which is usually the primary weekly cycle. However, sometimes it could be a half primary weekly cycle, so it cuts it short, and sometimes it can actually be longer too. If the primary weekly cycle is moving in an uptrend, the daily cycle tends to peak at the crest or high, with the beta cycle or the second half, which is like a right translated cycle. If the primary weekly cycle is in a downtrend, the daily cycle will tend to peak or have a high with the alpha crest, which is the first half. So you'd have a left translated cycle on the downtrend. Dominant cycles of different length interact in a predictable manner, as each cycle is affected by the larger cycle. So you always have to look at the higher time frames. You can't just go to like the 1 minute schizophrenic frame, all right? So when a larger cycle is moving down, the peaks of the smaller cycle shift to the left, which shows a left translated cycle. Also, the smaller cycle lows will be lower than the previous low. When the larger cycle is moving up, the peaks of the smaller cycle shift to the right, which shows the right translated cycle, and also smaller cycle will have the higher high than the previous high when it's going in an uptrend. So some of the concepts that are important is that there's actually three, but he only lists two. So we have the right translated cycle with the higher highs and the higher lows, and they tend to occur in a rising market, and the longer dominant cycle is moving up, and it's usually what we call an uptrend, right? And then you have a left translated cycle, which makes lower lows, lower highs, and tend to be in a falling market as the next dominant cycle is moving down in a downtrend. Each longer cycle determines the trend for the shorter cycle. If the direction of the longer cycle is known, then the trend is known for the shorter cycle. And here it is. This is showing you the translation. It's a little blurry. I do apologize. So these are your simple cycles, and this is your trend, right? So your uptrend, and then it peaks and then goes in a downtrend. So the third kind is the midpoint, which would be like a mid-translated cycle, which is right on the middle. If it was a 60-day cycle, 30 would be your high, your daily high, your daily cycle high, I should say. All right, so you could see here, like as you get a higher high and a higher low and a higher high and a higher low and a higher high and a higher low, you're on your right translating past the midpoint in an uptrend. And then in a left translated cycle, you're going to have a high, a low, a lower high, a lower low, a lower high, a lower low, a lower high, a lower low. And that's your left translated on a downtrend, a bear market, right? Okay, long-term cycles. It is recommended to start your analysis of the market with the long trend cycles. These are 2 to 11-year periods. These are your major bottoms that you want to go in and buy, right? So the position of the market relative to the longer cycle will often have an effect upon the seasonal and the primary or weekly cycle. Long-term cycles account for the major highs and lows on all charts. The big moves up or down usually occur around the highs and lows of these cycles. The longer-term cycles set the trend for the next shorter seasonal cycle. So then he goes on, he spends a lot of time in seasonal cycles because he traded like soybeans and all kinds of things. I don't even know. I wasn't really too interested in that part of the book, but I skimmed it. Okay, so seasonal cycles are more reliable in the agricultural markets because they have the known, like they know why their seasonality, because of their harvest. Did it grow enough? Is there poison in the farm? Who knows? Anything that causes the supply or the demand to go wrong. All right, and then you have seasonal tendencies that he make in all markets that he noticed in his career, and he noticed that the S&P, the lows tend to be made in September through November, or March or February, and the highs tend to be made August through October or sometimes April. Interest rates lows tend to occur in the first or third quarter, and the highs tend to occur in the third or fourth quarter. precious metal and bull markets, tendency to top in the first quarter and bottom in the second quarter, which makes sense because gold can probably top in the quarter one of this next year of 2025. In a bear market, they tend to see the bottom in the third quarter and top in the third or fourth quarter. Currencies, they tend to occur in May to September, and the highs tend to occur in November, April. So yeah, the lows tend to occur in May through September, and the highs tend to occur in November and April. And then he goes on and he discusses the primary weekly cycle. The most consistent aspect of markets is time, and the timing bands for the primary or weekly cycle tops and bottoms indicate when to look for specific patterns in the oscillators that will indicate a cycle top or bottom or high probability trade. So that's why you got to use your RSI or your MACD or whatever oscillator you're using, true strength indicator, to kind of see if the sellers are exhausted or if it's an overbought condition, that kind of thing. Now, if we look at break it down to weekly cycles, the most we talked about this. So there's two types. You have the simple primary, where it just goes from low to low you're measuring, and then it just goes from the low to the high, and then to the high to the low. Usually with like Bitcoin, you see the next one, the complex primary weekly. Sorry, that's not a daily. That's print. All right, so these are weekly cycles, and it's gonna go. You're gonna measure from. You're always gonna go like clockwise, right? When you're reading these things, so you go from low to low. Or low to low. Actually, you got to go from left to right, but low to low. But in this diagram, it's clockwise. So low to low, and then from low of the daily cycle to the half cycle daily low, because that exists. Remember, I spoke about that. This is your alpha, and this is your beta cycle. Okay. So then you go from the bottom to the crest, or the high. That gives you your half cycle high, or HCH, some people abbreviate it, and that takes you down to your half cycle low, HCL, and then you're off to your right. This would be, if this was a high, this would be a right translated cycle. If it was lower, this would be a left translated cycle, because that would be the top, and then it comes back down to the low, your daily cycle low. And that's basically the most important part. You need to understand this structure, all right, because you're going to see that a lot in the charts. So cyclic components of the primary weekly cycle. According to Bresserts' research on cycles, he coined the phrase 70% cycle timing bands because he found that 7 out of 10 times a cyclical component will top or bottom within 70% of the time in the cycle timing band. And approximately 20% will occur before and then 10% after. So more often you're gonna find that the bottoms occur in the correct cycle timing band, and then the other 20%, so 90%, a little bit before, and then the last 10% a little bit after that. So that's why you have that little wiggle room with the numbers. It's not an exact number. Nothing's exact in technical analysis. You have to understand that. Nothing is perfect, or else everybody would be doing it. All right. So the trading cycle, also known as the daily cycle, has 7 components. Some of this you might not need, but it's definitely what's in the book. So I want to know what it is, because that's how I learned. That's why I'm making this video, because I'm going to rewatch this video a million times until it's like burned into my brain. All right. So the 7 steps are the trading daily cycle low to the low. That's your daily cycle low to daily cycle low. That's what that means. And then, and there's a photo down. I'll show you. It'll make more sense. So you have your daily cycle low to your daily cycle low. You see where the mouse is right here? So it goes down here to here. Those are your daily cycle lows. And this says it was a 60-day cycle. This would be your halfway point, your 30-day point. All right. And you can see you have your alpha from low to high, your alpha from high to low, then your beta from low to high, and then your beta on your way down. This is like when you're searching for your next trade, because it's coming down, and you got to find the low, because that's where it's going to bottom out. So yeah, continuing on with the alpha cycle low to the low, that's from here to here, because that's your daily cycle low to your half cycle daily low. They're not going to be parallel like that, or if it breaks below this, is technically a cycle failure, but we'll get into that much in another video, put it that way. The beta cycle low to low, the alpha cycle low to high, the alpha cycle high to low, the beta cycle low to high, and the beta cycle high to beta cycle low. And now, very important, the counts that most people agree on in X and in the books, and Bob Lucas and stuff, people who really are cycle traders, like professional traders, This is their count that I found. So it's usually like a 60-day daily cycle count with a 10% window. So that gives you anywhere from 54 to 66 days. You're going to find a bottom, a daily cycle low, right? And then the weekly cycle count, which you're always going to fall. A daily cycle is always a daily cycle low will always fall on a weekly cycle low. So that's like if you get a weekly cycle low, it's even, you can go harder. And if you get a yearly cycle low, you go even harder because those only come every 4 years. So Bitcoin weekly cycles are anywhere from 24 to 42 weeks. And as everybody knows now, Bitcoin yearly cycle count, 4 years. And then you can see it in this video here. This is the trading cycle, also known as the daily cycle. And this is your daily cycle low to daily cycle low. Low and trough mean the same thing. And then crest and high mean the same thing, okay? So don't get caught up in the verbiage there. So you got your daily cycle low to your daily cycle low. You got your daily cycle low to your alpha cycle low. And then you have your alpha cycle low to your beta cycle low. And then you have your alpha cycle low to high, and then your alpha cycle high to low, beta cycle low to high, and beta cycle high to low. I know that's crazy, all that stuff, but it's good to know because it helps you like understand the structure of what's coming. You know, you can try to predict about where it's going to fall, you know, because you know if you're in an uptrend, it shouldn't break the previous daily cycle low. But we'll get into that more once we have a nice foundation of Bresserts cycle theory, and it'll make a lot more sense. And that's really the first chapter. That's really like a basis, like the basic verbiage and the basic concepts. He does go a little bit further on how he sets his charts up, but he does it on a bar chart, and he puts too much on his chart, if you ask me. He has the daily cycle lows, he has the alpha cycle low, the beta cycle low. It's just too much for me, and like it's probably more accurate the way he does it, to be honest with you. Maybe I'll try it out, but if the chart gets too messy, I'd rather just play the daily cycle lows, because the way he does it is he plays like the half cycle low, and he's short, so he'll play like the alpha cycle high and short that. He's a very courageous trader. I'm not, but I hope this content helps you, because it's really just for me, to be honest with you, so I can rewatch it and learn. But if you like it, like and subscribe down below, and I'll make some more.